Hello and welcome. Moss Adams is pleased to present today's webcast, Grow Your Not-for-Profit Financial Literacy, to members of Philanthropy Northwest. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I am pleased to introduce Julianne Bihar, Senior Program Manager at Philanthropy Northwest. Julianne?
Thank you so much and welcome everyone. We at Philanthropy Northwest are so excited to partner with our colleagues at Moss Adams for this event. There are a variety of roles, types of foundations, and geographies in our virtual room today. We have executive directors, board members, program officers, finance officers, grants managers, and more. We have community foundations, family foundations, government grant makers. I think we have some health conversion foundations, and we also have representation from Oregon, Hawaii, Washington, Montana, Alaska, and beyond. Thank you all for joining us. This session is an opportunity to refresh your skills on how to navigate a nonprofit financial statement, the Form 990, and other key financial indicators to support you as a funder partner to your grantees. May even support your financial fluency for your own organization. And we're so excited again to have Moss Adams as our partners in this event. Our presentation today will be given by Emina Cresswell and Hilary Tanneberg, both senior managers at Moss Adams. Their bios and contact information are located in your console if you would like more information. And now I will turn it over to Hilary to get us started.
Hi, good morning, everyone. I'm coming to you from the beautiful city of Yakima in central Washington. I'm excited to be here today. And as Julianne mentioned, I'm a senior manager at Moss Adams. I've been here since 2010, and I work primarily with not-for-profit organizations as well as higher education institutions. And I work on business assurance side of things, so audits, compilations, reviews, internal control review. And now I'll pass it off to Emina.
Awesome. Thank you, Hilary. Emina Cresswell, Tax Senior Manager. I do pretty much anything related to the Form 990, so tax compliance, consulting services. Have been with Moss Adams for the last 15 years. I've seen a variety of things throughout my career. I work with public charities, private foundations, colleges, universities, healthcare organizations, really anything that has a 501c code after it, that's what I get to do. So with that, we'll kickstart this conversation with kind of what's the agenda? What are we talking about today? Pretty much what is a non-for-profit or NFP organization? We'll go through some financial statements and the Form 990, and lastly, we'll briefly cover some key ratios for evaluating a nonprofit organization. So with that, we have our first polling question, just so we can gauge the audience a bit. So with that, Amy, let's kickstart our first polling question. So how familiar are you with NFP financials?
Sorry, I was just going to let the audience know, to respond, you will need to click the button next to the answer you choose and hit the submit button so that it records for your CPE certificate. And if you can't see the submit button, just please enlarge the slide area. And I do see some responses coming in through the Q&A window. You will need to respond on the actual slide itself to track your responses.
All right, a few more moments. We'll get to see the results very soon. I mentioned just to gauge kind of how familiar you are with nonprofit financial statements. So great. So I've read them and somewhat understand them for the majority with regular basis, but couldn't prepare a set of financials. So that's wonderful. Thank you. Appreciate that response. With that, let's dive in a little bit further into what is a nonprofit organization. So what are some characteristics of a nonprofit organization? Well, it receives contribution from resources with no expected financial return. And it operates for a purpose other than providing goods and services at a profit. So charitable class, serving a charitable class. And then one key difference really is also the absence of ownership. So with taxable organizations, there usually is an owner who gets some sort of interest. With these nonprofit organizations under state law are generally set up so that there are no owners. And then, of course, exempt under the IRS Code Section 501, as I sort of briefly mentioned, as they are recognized with the IRS. And then some other differentials with these types of organizations, of course, is they have different organizational goals, and they are really for altruistic purposes, greater good, social justice, public interest, economic advancements, or assistance for communities in need, education, health, and welfare. They pretty much encompass almost every imaginable activity that you can do for health and welfare, religion, education, research, and it's a contribution to society other than just to trying to make money. So that is their ultimate goal. They have a mission. They want to accomplish that mission and a goal. The stakeholders, well, in higher education, it's students and families. For other organizations, it could be the communities. For medical research, beneficiaries, donors. So there's a lot of different stakeholders from the public that are impacted by these nonprofit organizations. Different sources and uses of resources. So they could have membership fees, contribution revenue from the general public, governmental organizations, investment income as well, or other sources of income. So there's different sources of generating revenue. Their decision-making factors are quite different too. How is it that they advance their purpose, their mission? For higher education organizations, for example, how will their students and donors in the communities react to their decisions? Performance isn't always measured by profitability. While nonprofit organizations can have, of course, profitability and show that they have net income, But really, how do you drive success is they're looking at their goals and did they actually achieve what they said they would do, and did they contribute to their mission? So very different decision-making factors between a tax-exempt and a taxable organization. And then, of course, the users of financial statements are different people. The public, the donors, other foundations who want to give grants, financial institutions, banking, lenders, things like that, all use the financial statements for different purposes. And then just sort of a quick visual chart of what is the different types of nonprofit organizations that could be set up. They could be set up under state law as a nonprofit, and then they may not file a tax-exempt application with the IRS, so then they go into that not exempt bucket, and then they're taxed differently. They also could be, with the IRS, considered a tax-exempt organization. They could be charitable or non-charitable. So non-charitable organizations are your social welfare unions, credit unions, business associations, fraternities, social clubs, things like that. And then, of course, the charitable side is really your 501c3 organizations, and they could be either public charities or private foundations. And as you can see, there are different subsets within both the private foundation side, the operating and non-operating. Operating are more of those organizations that have program activities. The non-operating side is more on the grant makers. Public charities could be a definitional, such as a hospital, for example, or an educational institution, colleges, universities, or those publicly supported, your typical 501c3s that have contribution revenue, or they could be supporting organizations whereby they support another public charity. So a lot of different code sections under the IRS code. I think it goes up to 29, if I remember correctly. So a lot of different types of organizations that we could talk about today. All right. With that, I'm going to turn it over to Hilary to talk about what is a nonprofit organization.
Thanks, Emina. So now that we've had kind of an overview of the nonprofit types of organizations, we're now going to get into more of the details of the financial statements and some of the unique differences with not-for-profit organizations. So as Emina was just talking about who uses a not-for-profit's financials, and the users listed on this slide, some are similar to for-profit entities, such as regulatory agencies, governing boards, creditors, and potential creditors. However, two that are very different are funding sources and contributors. So your donors, your granting agencies, they're going to be using your financial statements to determine if you are an organization that they want to contribute to and or support, and they're going to use those financial statements to make sure that you're reporting correctly. There's no, if they're audited, there's no audit adjustments or auditor's opinion modification. Also, beneficiaries of services rendered by the NFP, the people that you're serving, they're also going to be looking back at your financial statements for a lot of the same reasons I just mentioned. And here's where your reputational risk really comes into play, because these people are relying on those financial statements to help, again, determine if they want to support your organization and support your overall mission. So there's a few different financial statement options if you wanted to have your financial statements looked at by an independent accountant. There are three types: an audit, a review, or a compilation. An audit is the highest level of assurance where the auditors come in and we verify material assets and liabilities. We do not look at every single dollar amount. You would not want us to do that. It would take forever. So based on our understanding of the organization and the industry and risks, we set a materiality and we focus on those material assets and liabilities. We provide an opinion on the financial statements, stating whether those financial statements, in our opinion, are correct, or are materially correct in accordance with generally accepted accounting principles. However, this is not a search for fraud or immaterial issues. If we ran across fraud, that would be communicated back to you. And ultimately, the goal is to prevent the reader from being misled. We want to make sure that the financial statements that are being presented are materially accurate so that people can rely on those to help make them decisions about the organization. The second option is a review, and on the scale of 1 to 10, 10 being an audit with absolute or the most assurance, a review would be about a 4 on that scale. And this is mostly inquiry and analytical procedures. Auditors would do no substantiation of the account balances, and we would provide an accountant's conclusion, however, not an overall opinion. And what we would say is that we're not aware of any material modifications that would need to be made in order for the statements to be in accordance with generally accepted accounting principles. The last main service is a compilation. This provides no assurance whatsoever. We simply take the numbers from your trial balance or the organization's trial balance and place them in the correct financial statement presentation. So now we're going to kind of look at American Red Cross as our example. We're going to dive into the financial statements a little bit more and talk about some of the financial statement differences and similarities between your not-for-profit organizations and a traditional for-profit company. So first off, some similarities. If they were audited, the auditor's report would look very similar. A classified balance sheet, this may or may not exist in a not-for-profit organization, and what a classified balance sheet means is that on your balance sheet you've got total current assets, non-current assets, total assets, and same with liabilities, current, non-current, total. You do not have to show a classified balance sheet, however, that is one possible similarity. Some of the similar accounts that you would see between the two financial statements would be cash, fixed assets, accounts receivable, accounts payable, and then in general, just the overall look of the financial statements would look fairly similar in that you would have assets, liabilities, and then some sort of a net asset section as well, comparable to an equity section in a for-profit organization. However, there are some distinct differences for not-for-profit organizations. The first is statement names, where you see the traditional income statement, balance sheet, statement of equity. Those are not applicable in not-for-profit organizations. The income statement is oftentimes referred to as the statement of activities. The balance sheet is oftentimes referred to as the statement of financial position, or if you're a GASB reporter, it would be statement of net position. And you could also have a statement of changes in net assets as well. A statement of functional expenses, a few years ago, a new accounting standard was implemented that required your functional expenses be shown by function and natural classification. It does not necessarily have to be a separate statement to the financial statements, but it would at least need to be disclosed, so that would be a difference. Some different accounts, contributions receivable. If you have split interest agreements, such as a charitable gift annuity, charitable remainder unit trust, those types of things, those are very distinct and unique to not-for-profit organizations. And then you also would have these two columns, your with and without donor restriction. That again is very similar or very unique to not-for-profit organizations. And then you've got your net assets down here as well. That is different. And here's just kind of a nice overview. Again, that balance sheet, statement of financial position, income statement, statement of activities. So again, you can see on here how it translates into the not-for-profit language. Now that we've had kind of a basic overview of those financial statements, we're going to get into some of the specific accounting for not-for-profits. But first, Amy, we have our next polling question.
All right, thank you. So our second polling question is, which of the following is restricted by the donor? A, board-designated endowment fund. B, board-designated capital fund. C, donor-advised funds. Or D, endowment fund.
Bit of a tricky question. We haven't maybe dived too much into restrictions, unrestricted. So just give it your best shot, and we will cover this in pretty good detail on the next slide. Okay, we're starting.
All right, we'll leave this up in 5 seconds here.
Okay.
right, here are the results.
Great. So most of the answers are donor advised or an endowment fund. That's correct. A donor advised could really go either way depending on some specific accounting guidance. We'll dive into this a little bit more, but anything that's board designated is not restricted. It's board designated. So we're going to talk about that here on the next slide, actually. So one of the biggest differences with not-for-profit organizations is this idea of net assets. And essentially, it's the equity of the organization, but that's not what we call it. We call it net assets. And for those of you that have been in the not-for-profit world for a long time, you can remember that net assets used to be 3 different types. You had your unrestricted, temporarily restricted, and permanently restricted. Again, a new accounting standard came out 4 or 5 years ago and said, we're going to scratch those 3 types, and we're going to get it down to 2. We're going to get it without donor restriction and with donor restriction. The hope was that reducing these and being a little more clear in the titles, it would help people understand a not-for-profit financial statements a little bit better. So the first type is net assets without donor restrictions. These are net assets available for use in general operations and not subject to donor restrictions. Within your without donor restrictions, you have board-designated net assets. This is unrestricted money, money without donor restriction, that the board has said, hey, we're going to hold on to this. We're going to use it for a building, or we're going to save it for reserves, or we're going to, reserve it for something. So it's not restricted, it's designated, and if there's any expenditures or any changes to that board designated money, that does need to be approved by the board. But again, it stays within that without donor restriction bucket. The second type is net assets with donor restrictions. And within that bucket, there's 2 types. The first is that some of these are temporary in nature, such as those that will be met by passage of time or other events specified by the donor. So the donor gives you money and says, hey, this must be used for scholarships. Well, then you restrict it. Once you award the scholarship, you release that money. Or they say, hold this for 5 years, and after 5 years, you may spend it on X, Y, and Z, or it may be unrestricted. So again, it could be held for a specific event or held for a specific time. The second type of with donor restriction net assets are those that are perpetual in nature, where the donor stipulates that the resources be maintained in perpetuity. Oftentimes, these end up in your endowment, and it's where the donor says, here's $1 million, never touch the $1 million, but anything that you earn on that $1 million, you can spend on X, Y, and Z, or they might say, it's unrestricted, use it how you would like. So again, within your donor restrictions, you've got some that are temporary and then some that are perpetual. So here's a detailed look at the statement of financial position. I know this is a little small, but here is where you can see some differences that we talked about, those contributions receivable shown up here in your current assets. And then down below again, you've got your 2 different types of net assets showing as well. So some things to consider when looking at a statement of financial position. The first item listed here is related parties. What is key here is really understanding those transactions, understanding the relationship, understanding the dependence between the 2 organizations. Sometimes might lead to more questions, but just a good way to understand exactly how the organization works. Looking at restricted cash, right, because this cash cannot be used freely. It is restricted for a certain purpose. So if the organization doesn't have any or very much unrestricted cash and a bunch of restricted cash, might raise a question about, how solvent they are, how liquid their assets are. Old accounts receivable or contributions receivable. The risk here is, can they actually collect those outstanding balances? And ultimately, that's something you would question about any company, is really old outstanding AR or accounts receivable. Question is, are those oldie and moldy and need to be written off, or are you actually going to be able to collect those balances? If there's no allowance noted, just a question about, is that reasonable? Do they have a big AR or contribution receivable balance? Can they collect on it again? Joint ventures and irredeemable investments. The big risk here is the valuation of those assets. They're hard to value investments. There's oftentimes restrictions on the liquidity of those, so how easily can the organization redeem their their interest in those investments. So anytime you see anything outside of your common mutual funds, common stock, start to ask questions and start to read more about what those are. Excess prepaid expenses, accounts payable or accrued liabilities in excess of vendor terms. What that means is the organization may not have the ability to pay their outstanding invoices. Maxed LOC is a maxed line of credit along with liquidity disclosures. This is really, again, just assessing, is the organization able to pay its upcoming debts? How liquid are they? Do they have enough liquid assets to cover them for a reasonable period of time? Capital leases, balloon payments is where they have an outstanding debt and the terms say no payments for the next 5 years, but in 5 years you have to pay all of it at $5 million. Well, again, can the organization afford that in 5 years? Without donor restriction deficit, I would say a deficit in any net asset category would be cause for question. This basically means that there's been an ongoing net loss, and so your net assets are getting negative. So again, kind of just a question about, can the organization continue to operate into the future? So now that we've covered the statement of financial position, we're going to move to the second main statement, which is your statement of activities. And this is a statement that shows operating results. So revenue minus expenses equals your change in net assets. And there are typically two types of revenues on your statement of activities. You have your support, which is your contributions and grants, or your fee for services, which, as Emina explained earlier, is program fees or membership dues. So again, two main types. In addition, you may have interest income as well as realized or unrealized gains and losses on your investments. And then again, I mentioned split interest agreements, so a change in value on your charitable gift annuities, charitable remainder trusts. Those may potentially also show up on that statement of activities. Again, here are some of the common types. Membership dues, government or other grants. Again, that investment income. In-kind donations, we oftentimes just see that disclosed. We don't necessarily see that on the financial statements. We'll talk about this just in a little bit farther down in the slides. Program or service fees, ticket sales or event income if you're a theater or other sort of performing arts or other ticket or event sales type organization. And then again, contributions is typically the big one for for not-for-profit organizations. And now here's kind of a detailed look at that statement of activities. So again, here at the top, you can see contributions. You've got corporate, United Way, contracts, including federal government, legacies and bequests. That's another pretty unique line item for not-for-profit organizations. Down below, you can see the functional expenses. Emina will be getting into this here in just a couple slides, but this is very unique to not-for-profit organizations. And this is where you can see those expenses broken out by function versus your natural classification, salary, wages, that type of item. And then lastly, you do see your net assets down here as well. Beginning of year, end of year, broken out by your two columns so that you can see exactly what is with and without donor restriction. I would like to point out, too, that there is a new accounting standard coming down the pike that requires contributed non-financial assets be shown separately in your financial statements. So up in that contribution category, you may have a separate line item that specifically calls out, again, contributed non-financial assets. Materiality can be applied to determine if it really needs to be broken out or not. But if you're receiving a significant amount of that, it would be expected that that is separately disclosed or noted in the financial statements. And now I'm going to pass it back to Emina to talk about statement of activities and the expenditures a little bit more.
Thank you. So with that, we'll dive into the statement of activities, in particular the expenses. As Hilary mentioned, they are in functional classifications between program, management and administrative, fundraising, and then membership development if appropriate. And as you saw in the previous slide, it had the different buckets broken out on the face of the financial statements, on the statement of activities. And then the expenses are really by natural classification as well, as she mentioned. So salaries, wages, benefits, program activities, services of that sort. So kind of a little visual here is the method of the grouping expenses is according to the purpose for which the costs are incurred. So in program expenses, you'll see, you can see it in different buckets by describing it based upon the program activity, such as grant expenses, instructional, housing services, things like that. So I'll show you kind of a visual after the slide what that looks like. And then you have your supporting services broken out between fundraising, management, and general is typically the categories you would see as I mentioned on the slide. This is where we break it down between programs. So you'll see in this example we have salaries and wages, employee benefits broken out, travel, equipment, depreciation, contractual services, etc. So you have these different classifications, natural classifications, but then you also have it by program activities. So in this case, in our example, we have program services that talk about services to armed forces, biomedical services, community services, really by program activity as to what is the organization's exempt purpose. So it really shows you, here's what we've applied for tax-exempt status, here's what our mission is, here's what we're doing, and here's how we've, here's our expenses by different category and program activity. And then you'll note on the furthest to the right, there's the total program services. Down below, you have the different breakout by supporting services, where it breaks down the fundraising column and the management and general column, and then, of course, the total again, and then a total of the all expenses as well. That should tie out to then your financial statements in general. So it breaks it down in much greater detail than you would typically see on a for-profit organization financial statement. And I'll talk about the 990 in a little bit, but this is really kind of what we also use for the Form 990 presentation and should correlate to that as well. And then when we do look at the statement of functional expenses, what are some areas to watch out for? What is it that we want to look at as we analyze these numbers? We look at the allocation percentages. So we look at, okay, what is the total percent for program expenses compared to total expenses? And then you also want to look at fundraising and management as well. Of course, with COVID and how things have been, you'll probably note, man, there were some fluctuations, some of these in 2020 and 2021 as organizations were differently impacted by the different shutdowns, revenue streams were different, and then, of course, the expenses, if they were shut down, I sometimes would expect to see that program expenses might be lower and management expenses might be higher during those years. So having a historical trend is always a good idea as well as you look through financial statements, given sort of what has happened in our economy and what has happened in the world. But definitely look at allocation percentages between the different buckets and see, how much of their time, how much of their expenses are they really doing on their program expenses. And then legal, taxes, administrative expenses. Are they in program? Do you see too much of that in the program bucket versus the management bucket, and why? So just ask questions as to, hey, what happened here? Can you describe? And then, of course, large fluctuations year over year. Historically, we haven't seen, usually you shouldn't see too many large fluctuations. But again, as I mentioned, with COVID-19, I would expect to see at least some fluctuations for some organizations, maybe not others, but something to look out for and definitely get some history on it. And then with that, I think I'm going to turn it back to Hilary to wrap up this section.
Great. So a few items to look out for when you're looking at the statement of activities is a revenue concentration, meaning maybe there's only a few donors that have given, or heavy reliance on a couple major federal grants or programs. That just, again, shows a heavy reliance on a small population of people or grantors, so just want to be aware of that. Conditional contributions, those are recognized as a deferred revenue until the condition has been met. So the organization doesn't get to recognize it as revenue until that condition is met. So you want to make sure that you understand what those are and assess if the organization really is going to be able to meet that condition in order to recognize that revenue. Restrictions on revenue, simply because it limits their ability to use the money. Any reclassifications, those are fairly common, but if it's a big dollar amount, may want to make sure and read and get a good understanding of what causes that. Negative operating results or negative overall investment income, again, that just kind of raises questions about the organization's ability to continue into the future potentially. The one thing I would say about investment income is those unrealized gains and losses, which is just a change in the market value, can fluctuate wildly, and we've seen that a lot through the pandemic. So when you're evaluating that, even if you see a negative operating result, you want to make sure and look at that statement of cash flows, which we'll talk about on the next slide, because you may have a negative operating result, but you may have positive cash flow. Those unrealized gains losses are not cash. They impact your operating line, but they don't actually provide cash or take cash out. Other income and expense items, just understanding what those are. Restatements, you want to understand why was it restated, what caused the restatement. A negative change in net assets, similar to what I was just talking about. And then a release to your perpetual restriction that could indicate an underwater endowment, meaning the fair value of that portfolio is below the original gift value. Just raises concern about that investment portfolio is not performing as expected. So the third and final main financial statement piece or statement within the statement is your statement of cash flows. And so your cash flow is reported for 3 activities such as financing, investing, and operating. Here's an example of your statement of cash flows. Here you can see operating, investing, and financing. So what this statement is telling you is, okay, here's our operating results, but here's a bunch of items that are on that impact that operating result that aren't cash, such as depreciation, again, the unrealized gains or losses. And so it's really trying to help the reader understand, okay, from the statement of activities, what's their true cash in and out? So this is a fairly important statement to read. It's a little maybe overwhelming, but if you take some time and try to understand it, you'll see ultimately the cash coming in and out and really gives you a good idea of the organization's liquidity and ability to continue funding its operations. Liquidity footnote. I keep mentioning this new accounting standard that came out a few years ago. This is also part of that accounting standard, ASU 2016-14. What's unique about this footnote is when you look at financial statement footnotes, those are almost always, well, not almost always, they're always looking back at the year. So looking back at 12/31/21, looking back at 6/30/2021. This footnote actually has you look ahead 12 months to determine what is your liquidity of your organization for the next 12 months from the statement of financial position date. So this footnote requires qualitative and quantitative disclosure. The qualitative disclosure would discuss how the organization manages its liquid resources to meet operational cash needs within 1 year of the statement of financial position date. It would describe the availability of the not-for-profit's financial assets. And as a reminder, the availability of those assets can be affected by the nature of the asset, limits imposed by donors, grantors, laws and contracts, or internal limits imposed by the board. One thing that this footnote caused a lot of organizations to do was to actually look at their internal policies and see if they actually had a liquidity policy. And if not, then it started to drive a lot of organizations to look at that and say, hey, should we develop a policy about how much liquid assets we should have on hand? 3 months of operating reserves, or $1 million cash, or whatever your organization thinks. So if you haven't adopted a policy, consider looking at your liquidity and maybe adopting a policy. And once that's adopted, that basically becomes your qualitative disclosure for this footnote. The quantitative disclosure is the dollar amount of financial assets available to meet cash needs within 1 year of the statement of financial position date, so simply the dollar amount. And this can be shown on the statement of financial position or in a separate footnote, as we're going to see here in just the next slide. So here's one example of how the liquidity footnote could look. Some common financial assets are cash, cash equivalents, short-term investments, receivables, pledges receivable, inventory. Those all could be considered financial assets available within 1 year. In this specific footnote, they also added the fact that they've got a line of credit as well as some board-designated endowments that could be used for operations to ultimately say, as of June 30, 2019, we have $110,000 of liquid assets available for use in the next 12 months. So again, it's looking ahead saying, here's what we can spend over the next 12 months. Some restrictions, again, limiting the use of your financial assets, donor restrictions, board designations, assets held as collateral, cash balance limits resulting from contractual agreements with vendors or creditors, cash required to be held in separate accounts or restricted for a specific purpose, or specific loan covenants that may require you to hold a certain amount of cash. If you had any of those limiting the restriction, limiting the use on those financial assets, you would actually back those out of total financial assets available to get down to that net number. Now that we have made it through the financial statements, I'm going to give it back to Emina to talk about some tax-exempt compliance items.
Awesome. Thank you, Hilary. Of course, everyone's favorite topic, taxes. But before we dive in, another polling question. So, Amy, to you.
All right, thank you. So the third polling question is, what part of the Form 990 do you go to first when learning about a new entity or to make sure it's correct about your own? Is it Part 1, Schedule O, Part 7, D, something different, or E, I avoid looking at Form 990 at all costs? And also, you do have the option to submit questions for the presenters using the Q&A window. We do have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards.
See what the results are.
All right, here are the results.
Avoid looking at the Form 990 at all costs. I was really hoping that wasn't the most popular answer, but that's okay. I'll walk you guys through it. We'll talk about it in a little bit and some other compliance things, so it won't be as scary, I promise. So with that, of course, there's the Form 990, but there's also other informational reporting requirements that tax-exempt organizations have to do as well, such as employee payroll taxes, the Form 941, W-2s, independent contractors and other payments, so your 1099s, and then foreign contractors, the 1042Ss and Form 1042. There's also foreign reporting, so if they have foreign bank accounts, foreign ownership, foreign investments, things like that. There's Form 5471, 5472, 8865. I mean, galore. There's a galore of tax forms that could be possibly filed that go along with a tax-exempt organization filing. And then, of course, there's state solicitation and tax reporting requirements as well, because every state has different rules and would like for you to register with the state to say, hey, we'd like to get money from your public. Please allow us to operate in your state. So those are kind of the state solicitation requirements. And then, of course, retirement and benefit plan compliances, so your Form 5500s would be included in here as well. And then the 990, it is an informational return in IRS terms versus a tax return. And it really has a deep dive into, hey, here's your compliance. So you're answering questions about how many Form 1099s you filed, Do you have any foreign bank accounts? Do you have any foreign investments? Are you filing these different foreign forms? Are you filing W-2s, 1099s, and other compliance forms that might be required? It also asks questions about operational and governance practices. So there is usually a large chunk of questions that there's yes and no's, and if there are certain yes and no answers, they require additional disclosures on Schedule O. Basically, the Form 990 has a lot of words on it, and it's really there so that you can tell your story. So tax-exempt organizations can really use the Form 990 to talk about themselves. Here's what we've done. Here's how they've operated. Here's their activities. And then they also describe it with a lot of words, which is very unusual from other tax return filings, because all the other tax return filings are very number-based, whereas the Form 990 has a bit of both. And then it is available for public inspection, except for Schedule B, which is the contributor schedule. And so that's why it's very important that the organization really presents themselves in the best light possible and tells their story as to here's what we've done, here's all the things we've accomplished. And then some members of the public rely on the Form 990 as their primary or sole source of information about a particular organization. One thing to note, it has to be a complete, accurate, and fully described return that describes organization's programs and accomplishments. So that's in particular Part 3 of the Form 990. That's the part I usually guide board members when I have board meetings. Take a look at that. See what they do. Here's what they've done. Doesn't really describe what the organization is doing and has done in the past. Okay, so some other users of the Form 990, government agencies, the donors, the charity watchdogs. So think of GuideStar, for example, the states where they're registered in, news agencies and reporters. You would be amazed how many news agencies and reporters look at these Form 990s, request a copy, and just want to know more. Hey, is this organization doing what they said they were doing? And does it make sense? So many users, the public really is what it comes down to. And then here's kind of the schedule and the breakdown. There's, of course, the core Form 990, which consists of 12 pages. And depending on how they answer the yes and no questions regarding their activities and what they've done in the past, they could have up to 16 schedules. For publicly supported organization, you can have Schedule A, public support. That's where they show the organization, the public, hey, we are truly publicly funded, not funded by one major donor as an example. Schedule B, like I said, is not available to the public, but this is where it goes to the IRS. And then many of these other schedules are particular activities that describe foreign activities, fundraising activities for those hospital organizations. Schedule I, grants to organizations and individuals. Schedule J is always a hot topic one because it has compensation details. That's what a lot of people tend to look at to make sure that they have reasonable compensation. That's what the IRS looks at, along with other schedules as well. So there's kind of a breakdown of all the different schedules that you can possibly see on the Form 990, and I promise you they're not as bad as they look. They just provide you a lot of information that you might find useful as you try to assess an organization as a grant maker, as a board member, or whatever your position might be, or you yourself, from a financial perspective. And then, of course, there's the Form 990T. The Form 990T is an actual tax return whereby the organization files this to report activities that are considered unrelated business income activities. These activities are really regularly carried on for profit purpose and unrelated to the organization's charitable purpose. You would also use this form to report taxable income of tax-exempt entities. So if you have partnership investments that might be generating unrelated business income and provide you a Schedule K1, this is where you would report this. and the tax rate is 21% at this point in time. Who knows what it's going to be in the future, but it's a flat rate at this point. And then typically, if they do have form filings, this is where you would also attach it to the Form 990B, Form 926s, 88s, 51s, etc. So sort of some of the other forms that I've mentioned before. And then this proxy tax related to lobbying activities. I won't cover this in too much detail, but this is essentially a tax that 501c 4, 5, and 6 organizations might have. But we'll just focus on the public charities, and so typically this tax wouldn't be reported for public charities as they don't do lobbying activity required. All right, we'll briefly cover some ratios now that we've talked about taxes, and whereby you can use the financial statements and also the Form 990 to do some ratios to assess how is the organization operating. Are they efficient in what they're doing, and that we think you might find helpful. So I won't cover through all these ratios, so I believe you will have slides that you can refer back to. I did wanted to point out the contributions and grants ratio 1, which is the accounts payable times 12 divided by total expenses. And really this one is an accounts payable indicator, which sheds light upon the creditworthiness of the organization. So the lower the indicator, the faster the organization pays its bills. So that's a good metric to look at. The next one on the next slide is the program ratio. I covered this briefly when I talked earlier about program activities and functional expenses, but this one is where you look at the program service expenses over total expenses. Really measures the relationship between how the program, how efficient are they, how much activities are they doing for program expenses compared to management and fundraising expenses. So younger organizations could have a lower program ratio than the more mature organizations, so keep that in mind as you are looking at the Form 990 and the financial statements of an organization. Kind of, how young is this organization? Are they just starting up? We would expect to see more management rather than program, and then eventually more program than management. And as I mentioned, with the pandemic, we have seen organizations that had to have the shutdowns and couldn't do their program activities because they were in person and required that in-person activity. So some things to keep in mind there too is kind of take it with a grain of salt and really read the financial statements, as it will tell you kind of about the organization. And then the last ratio I did wanted to mention is, I'm going to kind of skip through some of these slides. As I mentioned, you have these, so hopefully you can use these for your purposes, is this last one, the Charity Navigator ratios as well. I like to use the fundraising efficiency ratio when I have discussions with board members or organizations, whereby I look at their average fundraising expenses and their average total contributions to see how efficient are they at actually raising funds. Now, you do have to look at kind of a trend over the last 2 to 3 years, even 4 or 5 if you wanted to. I typically like to look at a 5-year span just to see, where my fundraising expense is pretty high one year, but then my contribution revenue was high the next year. Pretty good efficiency there. So just wanted to mention this ratio here too in case you were curious. With that, I believe we are at our last polling question. So Amy?
All right, thank you. So yes, the last question is, how much more comfortable are you with financial reporting and compliance requirements? A, much more comfortable, C, somewhat more comfortable, or B, somewhat more comfortable, sorry, or C, my brain is overloaded. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts in your console. And then also, once you've completed all CPE requirements, you can also download a PDF of your certificate from the CPE progress window in your console.
I think my brain is overloaded, if that counts.
All right, here are the results.
Definitely a lot of information. Yep. As expected. Yeah. Awesome. Well, with that, if there are any questions, we are at the end of our presentation. If there's any follow-up questions after this, please feel free to reach out to us as well. We do have one question in the chat, and we will get in touch with that individual through the chat just to get some clarifications on that question. Other than that, I think we'll give you guys a moment to see if there's any more questions that will come up through our Q&A session. Wrap it up. So really appreciate you guys' time. As we said, here's our contact information. Reach out to us if there's anything. Well.
All right. Thank you, Emina and Hilary, for a great presentation today. And then also, if you have difficulty downloading your CPE certificate now, we will email out a copy within 3 weeks as well. And then also a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet that's found in your console. And finally, here is a link to an online survey for today's presentation. And Julianne does encourage all of you to fill out the survey, as your feedback is very important to Philanthropy Northwest. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.